Welcome back, traders. Happy to have you here today. In this short video, I will show you how to identify and implement the best pullback trading strategies to execute profitable trade setups in the market. Learning how to trade pullbacks can be a great skill as a trader. Pullbacks happen all the time, and if you learn how to trade pullbacks, you can improve your winning rates and find many more high-probability trading setups. What's a pullback in the financial market? As we all know, prices don't move in a straight line. Instead, the price movements of any financial instrument operates in waves. The markets fluctuate between rising and falling trend waves. During an uptrend, the dominant trend waves tend to move higher. And there usually comes a time whereby there would be a correction of waves against the primary uptrend direction. The correction of waves is tagged as a corrective wave, while the dominant trend is tagged as an impulsive wave in technical analysis. Same applies in a downtrend. In a strong downtrend, there will definitely come a time where the bulls will exercise short bullish interest. Remember, it's risky to chase trends in the financial market. Not chasing a trend simply means we should look out for when price makes a trend retracement or a counter-trend move. This price retracement or counter-trend movement is called the pullback. The idea behind waiting for a price pullback during a trend is to provide you with a better entry price level. For instance, if the market is moving higher and you analyze the trend that the move will continue, you will want to execute a position at the lowest price possible. Pullbacks help you find such opportunities. There are 4 best pullback trading strategies to execute profitable trade setups in the market, and they are Breakout of Key Level Pullback, Trendline Pullback, Moving Average Pullback, and lastly, Fibonacci Pullback. Take note, to have a higher winning rate through application of any of these 4 pullback trading strategies, make sure you apply them to trade along with the dominant trend. Key levels are support and resistance levels on the trading charts. Price tends to make a pullback to this level after a price breakout occurs above or below this level. In a strong bullish trend, whenever price breaks a resistance level, price usually makes a pullback to retest this level, thereby validating as a new support level. As we can see on this chart, we were in a strong bullish rally. We can see how price broke the previous resistance key level here. Price later made a pullback, and this broken resistance key level proved as a new support for price, thereby rejecting price into a more bullish rally. Likewise, in a strong bearish move, whenever price breaks a support level, price usually makes a pullback to retest this level, thereby validating as a new resistance level. As we can see on this bearish trend, sellers were selling aggressively. Price broke the support level here, and there was a pullback to the key level structure. What happened next? Price was rejected into a more bearish trend, which means the previous support level here is now a new resistance level for price. The next pullback trading strategy is the trendline pullback. Trend lines are another famous pullback tool. Although trend lines often take longer to be validated, you can simply connect 2 price points to form a trend line, but 3 points will make it more reliable. Therefore, the trend line pullback can only be traded at the 3rd, 4th, or 5th contact point. But take note that these pullback points are not within a short range interval. A continuous retest of a trend line within a short period signifies a weak trend line. As we can see in this market, the market was on a strong bearish rally. We can see on the third pullback of price to the trend line, price was rejected into a more bearish trend. Take note, a strong and reliable trend line will sharply reject price whenever price makes a pullback to test it. We can see how price repeated pullback retest and price keeps respecting the trendline rejection to the downside. Here's an example of a trendline pullback in a dominant bullish trend. We can see how prices always find rejection to the upside after each pullback to the trend line. Trend lines can work nicely in addition to other pullback methods, but as a standalone method, the trader may miss many opportunities when the trendline validation takes a long time. The next pullback trading strategy is the moving average. Although there are a lot of trading indicators which you can implement for pullback trading strategy in the market, but one of the easiest ones to learn how to utilize is the moving average indicator. You could use a 20, 50, or even a 100 period moving average. The period you prefer to use doesn't really matter. Your period of choice depends on your trading methodology. Are you a short-term or long-term trader? Shorter-term traders generally use shorter moving averages to get signals quicker. Of course, shorter moving averages are also more vulnerable to noise and wrong signals. Longer-term moving averages, on the other hand, move slower and are less vulnerable to noise, but traders may miss trading opportunities in the short term. It's better to backtest the period which is suitable for you. I prefer to use the 50 moving average. All I need to do is to trade pullback of this moving average along with the dominant trend. As we can see on this bullish trend, whenever price makes a pullback to the moving average, price finds support. And this transformed the trend into a more bullish rally. Same applies to the bearish rally we have here. The moving rejected price into more bearish trend after a pullback testing the moving average. Take note, it is very common for price to overshoot the moving average and show very deep pullbacks. That is why you need to give your stop loss more breathing room if you choose a moving average pullback strategy. The next pullback trading strategy is the Fibonacci pullback strategy. This is the most commonly used pullback trading strategy among professional traders in the financial market. To implement the Fibonacci tool, you wait for a new emerging trend and then draw your Fibonacci tool from the trend origin to the end of the trend wave. There are a handful of Fibonacci levels that seem to be more important to most traders, which are the 50% and the 61.8% Fibonacci retracement level being the most desirable. Also, the 38.2% Fibonacci retracement level. As we can see on this chart, the 38.2% Fibonacci retracement level acted as a support for price in this bullish rally. We can as well see how the 50% Fibonacci retracement level held price upward. Also, we can see how price respected the 61.8% Fibonacci retracement level. Therefore, to implement the Fibonacci tool for pullback trading strategy in the market, watch out for price reaction at the 38%, 50%, and 61.8% Fibonacci retracement level. Remember to practicalize this pullback trading strategy on a demo account first before applying it on a live trading account.